Welcome to our exploration of monopoly pricing and inefficiency. In this video, we'll break down how a single-price monopoly operates compared to a competitive market, and why this difference leads to welfare loss. Understanding these concepts is crucial for grasping the broader impacts monopolies have on consumers, producers, and overall economic welfare. Let's begin by defining what a monopoly is, and how it differs from a competitive market structure. Monopoly exists when a single firm is the sole producer of a product with no close substitutes. This firm has significant control over the market price, unlike firms in competitive markets. Monopolies can arise due to barriers to entry, such as patents, resource ownership, or government regulation. This unique position allows the monopolist to set prices higher than in competitive markets, impacting both consumers and overall market efficiency. Contrast, a competitive market features many sellers offering similar products. No single firm can influence the market price. Instead, prices are determined by supply and demand. Firms in competitive markets are price takers, meaning they accept the market price as given. This structure leads to efficient resource allocation, as firms produce at the lowest possible cost and consumers pay prices that reflect the true value of goods. Single-price monopoly has the unique ability to set its own price, constrained only by consumer demand. Unlike competitive firms, the monopolist faces the market demand curve directly. By restricting output, the monopolist can raise prices above competitive levels, maximizing its profits but reducing the quantity available to consumers. This pricing power is a key source of inefficiency in monopoly markets. For a monopoly, the demand curve is downward sloping, meaning the firm must lower its price to sell more units. This creates a marginal revenue curve that lies below the demand curve. Each additional unit sold adds less to total revenue than the price at which it is sold. This relationship is crucial for understanding how monopolies decide on the profit-maximizing level of output. Monopoly maximizes profit where marginal revenue equals marginal cost. At this point, the monopolist chooses the quantity to produce and then uses the demand curve to set the highest price consumers are willing to pay for that quantity. This process results in a higher price and lower quantity than what would be found in a competitive market, highlighting the inefficiency of monopoly pricing. A perfectly competitive market, firms produce where price equals marginal cost. This ensures that resources are allocated efficiently and the quantity produced maximizes total surplus for society. Consumers benefit from lower prices and greater availability of goods, while firms earn only normal profits in the long run. This outcome is often considered the benchmark for economic efficiency. When we compare monopoly and competitive markets, a clear pattern emerges. Monopolies charge higher prices and produce less output than competitive firms. This difference is not just a matter of profit, it has real consequences for consumers, who face higher costs and fewer choices. The reduction in output also means that some mutually beneficial trades do not occur, leading to a loss in overall welfare. Consumer surplus is the difference between what consumers are willing to pay and what they actually pay. In competitive markets, consumer surplus is maximized because prices are lower and more goods are available. Under monopoly, higher prices and restricted output reduce consumer surplus, meaning consumers get less value for their money and some are priced out of the market entirely. Producer surplus represents the difference between what producers receive for a good and their cost of producing it. Monopolies can increase their producer surplus by charging higher prices, but this comes at the expense of consumer surplus and overall welfare. While the monopolist benefits, the gains do not fully offset the losses to consumers and society. Deadweight loss is the reduction in total surplus that occurs when market output is not at the efficient level. In monopoly, this loss arises because the monopolist restricts output to raise prices, preventing some trades that would have benefited both buyers and sellers. This inefficiency is a key argument against monopolies in economic theory. Visualizing the differences between monopoly and competition helps clarify the impact on prices, output, and welfare. On a standard supply and demand graph, the monopoly outcome shows a higher price and lower quantity than the competitive equilibrium. The area representing deadweight loss illustrates the trades that do not occur under monopoly, highlighting the inefficiency. Monopolies often exist because of barriers to entry that prevent other firms from entering the market. These barriers can include legal protections like patents, control over essential resources, or economies of scale that make competition difficult. Such barriers allow the monopolist to maintain its market power and continue charging higher prices. Some monopolies are considered natural because a single firm can supply the entire market at a lower cost than multiple firms. Examples include utilities like water and electricity. In these cases, competition may not be practical, but regulation is often necessary to prevent excessive pricing and protect consumers. While our focus is on single-price monopolies, it's worth noting that some monopolists engage in price discrimination, charging different prices to different consumers. This can increase profits and sometimes reduce deadweight loss, but it also raises concerns about fairness and market power. Governments often regulate monopolies to protect consumers and improve market outcomes. Regulation can take the form of price controls, public ownership, or antitrust laws designed to promote competition. The goal is to reduce inefficiency and ensure that consumers are not exploited by monopoly power. Real-world examples of monopolies include utility companies, pharmaceutical firms with patent protection, and some tech giants. Each case demonstrates how monopoly power can lead to higher prices, restricted output, and the need for oversight to balance interests of consumers and producers. Welfare loss from monopoly arises because some consumers who value the product more than its cost of production are unable to buy it at the monopoly price. This means that total surplus, the sum of consumer and producer surplus, is lower than in a competitive market. The deadweight loss represents the value of these missed opportunities. On a supply and demand graph, the welfare loss from monopoly is shown as the area between the demand and supply curves, from the monopoly quantity to the competitive quantity. This area visually captures the reduction in total surplus caused by monopoly pricing and restricted output. Over time, monopoly power can stifle innovation and reduce incentives for efficiency. Without competitive pressure, monopolists may not invest in cost-saving technologies or improvements in quality. This can lead to higher costs and lower productivity, further harming consumers and the economy. Monopolies may engage in rent-seeking, using resources to maintain their market power rather than creating value. This includes lobbying for favorable regulations or legal protections. Such activities divert resources from productive uses and can further increase inefficiency in the economy. With only one producer, consumers have fewer choices and less bargaining power. This lack of competition can lead to lower quality, less variety, and slower innovation. The monopolies' focus on profit maximization often comes at the expense of consumer satisfaction. Market power allows monopolies to influence prices and output, but this often reduces social welfare. The loss in consumer surplus and the creation of deadweight loss mean that society as a whole is worse off compared to a competitive market. Policymakers must weigh these costs when considering how to address monopoly power. Antitrust policies are designed to prevent the formation of monopolies and promote competition. These laws prohibit practices like price fixing, market division, and mergers that reduce competition. Effective enforcement helps maintain market efficiency and protect consumer interests. While monopolies can sometimes use their profits to fund research and development, the lack of competitive pressure may reduce their incentive to innovate. In contrast, competitive markets often drive firms to innovate to gain an edge, benefiting consumers with better products and services. In practice, monopolies set prices by estimating consumer demand and choosing the price and quantity that maximize profit. This process often involves sophisticated market analysis and strategic decision-making, but the end result is usually higher prices and lower output than in competitive markets. Consumer advocacy groups play an important role in monitoring monopolistic practices and pushing for regulation. By raising awareness and lobbying for policy changes, these groups help ensure that markets remain fair and competitive, protecting the interests of the public. Monopoly power and its consequences are not limited to one country. Around the world, governments face similar challenges in regulating monopolies and promoting competition. International cooperation and the sharing of best practices can help address these issues on a global scale. To recap, single-price monopolies differ from competitive markets in their ability to set prices and restrict output. This leads to higher prices, lower consumer surplus and deadweight loss, and overall reduction in economic welfare. Understanding these differences is essential for evaluating the role of monopolies in the economy and the importance of regulation. Monopoly pricing and inefficiency are central topics in economics, shaping how we think about markets and regulation. By comparing monopolies to competitive markets, we see the importance of competition for promoting efficiency and consumer welfare. As economies evolve, ongoing attention to market structure and policy will remain crucial for balancing the interests of consumers, producers, and society as a whole.